ACA, Garrett Planning Network, and other organizations seeking insurance-related education. Please welcome Mark Maurer.
Well, hello, everybody. Thank you for tuning in, and to everybody I just happened to see, hard to believe it was last week in Salt Lake City. It was great to see you. And so let's jump right into, it's our number 4, but we're on the number 3, and we're going to talk about term life insurance. And even before we get started on all the different ideas, we talked about, I split it up into 3 stages. And so we have the young stage, or that little baby, where we're talking about the basics of term or term layering, and then in middle age you grow a really nice mustache, and we start to talk about group term and how does it compare to individual coverage, and maybe having term in a business. And then for someone who's older, start to have a really nice big full white beard, and we start looking at pension max, which is permanent insurance plus term insurance, and converting term policies if someone's health maybe has declined since the original term policy was taken out. So we're going to touch on the basics of term, designing a layered term policy, looking at coverage through group, and then the pension max and conversion ideas. So when you're young, we look at the basics of term. Term is great for your younger clients. And of course, my favorite number 3 is the Three Stooges. So we're going to use Larry, Curly, and Moe for a little fun. Well, your client's biggest asset when they're young is probably not their 401k. It's probably not their 1985 Honda Accord. It is their income. And what I mean by income, even if it's not their income now, it's the cumulative impact of 20, 30, 40 years of income on how they use that income to pay for the basics of insurance, to fund retirement plans, personal savings, even then to pass it on as a legacy to children. So we use term insurance to protect that in case your clients die prematurely. So what makes term attractive to 20 or 30-year-olds? Well, it's a fixed guaranteed death benefit. It's not going to change, and it has a fixed guaranteed premium. Somebody who puts everything I possibly can on monthly bank drafts so I don't forget it, I love fixed or guaranteed premiums. And we can lock in that premium for up to 30 years. Term also guarantees insurability. So when you're young, this probably isn't something you think about. Wasn't that long ago when I thought I was 7 feet tall and bulletproof. But getting a 20-year term or a 30-year term with a conversion period allows your clients to lock in their insurability for the long run. And so at the end of the term period, they can exchange that term policy for a permanent policy without having to pay higher premiums because their health has changed. So the term allows for a lot of coverage today, a low premium, and then builds in that flexibility at the end of the term period to make changes. And it's important with term policies to look at the conversion options. And just to make sure that the term in general should match, the conversion period should match the length of the term policy. And then so term makes a lot of sense for most clients. And then probably question number 2, or usually question number 1 is, but what does it cost? The underwriting class determines the premium cost. That's a big indicator. I mean, your client is 32. They can't change that. That's not a variable. They're male or female. That's not a variable. But what is variable is maybe the cholesterol rates between a whole bunch of different 32-year-olds, or their tobacco status. Those are things where a client who's 32 would be classified maybe as a preferred plus, or a preferred best, super preferred, preferred elite, whatever insurance companies want to classify, call that super best rate. And all the way down, preferred, a standard, smoker ratings. There's table ratings or substandard rates, flat extras for particular health conditions or avocations. So all of these things determine what the actual insurance costs. So if we take Mo, he's 28, and in that picture he has some new kids, And so his Three Stooges career is really going along, and so he needs $2 million of life insurance. His NAPFA advisor, who was, or a fee-only planner, was helping out before they even knew there was such a thing. So the fee-only planner helped out and said, you need $2 million of life insurance. And so he said, well, great, the kids will be out of the house when they're 20, so let's look at a 20-year term policy for $2 million. And assuming Mo is a preferred, not the super preferred, his rate would be $1,060 per year, guaranteed, locked in for the next 20 years. And Helen, female rates are lower than male rates, so Helen's policy, all things being equal, would be $800 per year. So now we're going to design some layered term the wise way. What are your client's top 3 reasons to have term life insurance? And I'm going to interject myself a little bit here. These are my top 3 reasons for having term life insurance. Number 1, minor children. My kids are 4 and 6. If something happened to me and was unable to earn my income for the next 20 or 30 years, I'd really love to say it's 20. It's probably more like 50. But that would be my number 1 reason for having the life insurance. Number 2, because it scares the heck out of me, is college funding. So to make sure that not only have I been able to support my children while they're minors, but even to be able to support them through college. And then, of course, like all parents, we do everything else for our kids first, and then, hey, maybe right before I retire, you know what, I probably should start saving for some retirement, so I don't have to move in with the kids. So all of these are 3 different life events that happen generally at different times, and so can we layer our term policies to coincide with these different life events? Oh, absolutely. And is it a perfect science? No, but we take our best guess. Kids, we plan on kids going to college for 4 years. They may be on the 5-year, 6-year, 8-year plan. Retirement used to be age 62 or age 65, and a lot of people don't retire until 70. So we take our best guess, but having these different policies that coincide with those different life events. It really works better for the most part with larger policies. Multiple small policies can be pretty inefficient, and why? Well, life insurance policies, especially term, are banded, a lot like breakpoints in the investment world. So a $499,000 policy will actually have a higher annual premium than a $500,000 policy. And each particular policy generally has a $50 to $60 to $70 policy fee, just an annual fee for having the policy, issuing the policy. But there are a few carriers that offer a multi-policy discount. So this is something when we start discussing policies or design with you and your clients, we definitely look at those companies first when we're looking at a layered approach. But so why do we do this? I said we need it at different events, but what's the theory behind it? Well, the theory is that as Curly earns his income, every year that he gets his Three Stooges money, that's another year that he's paid for, he's done some retirement savings, he's paid down his mortgage another 12 months. As time goes on, there are fewer years to replace an income, so the need for income replacement is less as we get closer to that retirement date. So keeping in our program of 3s, we're going to have 3 options, and you can probably guess that number 3 is going to be my favorite. But Curly is preferred non-smoker, $2 million, and he gets a 30-year term because that's the one that's closest to his estimated retirement, and for the most part, the longest term policy that 99% of insurance companies offer. And so if we say, well, okay, that's going to cover about as much as we can, sort of the longest of our events, then we need a $2 million policy, and an annual premium would be $1,700. Well, what if we split that up? And let's split it into 2 parts. Okay, well, in 25 years, the kids will no longer be minors. Hopefully most of college will be paid off. So let's break that into $1 million of 25 and $1 million of 30-year term. Okay, well, that lowers the annual premium by about $90. So that's pretty good, but nothing necessarily to write home about. So let's look at our number 3, or a 3-layer option. See how many times I got 3 in there? Our third option is going to be the best. So we're going to layer 3 policies to coincide with our 3 life events. So we have $1 million of 15-year term, gets the kids out of the house. $500,000 of 20-year term covers Curly while he's paying off college. And then the last $500,000 for the next 30 years, make sure that while he's in the last years of his Three Stooges fame, maybe getting royalties and things like that, that there's money there for his spouse should he die to finish up that retirement planning. And so what we see here is that you can, SBLI has the lowest premiums for pure standalone policies. Banner is one of the policies that has a multi-policy discount. So from $12.10 to $11.55, that's, saves $60, $70 a year. That's pretty good. But when we compare to option 1 or option 2, we're saving a few $100s a year. So looking at the layering option between, so we still have the full $2 million for the first 15 year with the 3 policy layer, but a savings of 28 to 32% each year initially over option 1 and option 2. And then when the term policies drop off, then the client's saving even more, Curly's saving even more because he's only paying for the 20 and 30-year term, or then in 20 years only paying for the 30-year term policy. So we've sort of quickly gone through the young age, your clients who are in their 20s, who are 30s, who their number one worry is not being able to earn an income because that's sort of, they have little to nothing, but nothing else but time and the expectation of 30 or 40 years of income. And so now that we've gone into middle age, we've advanced a little bit. So we're going to look at the group term that many of your clients have. And we're going to also look at how we use term to protect a business. And so another famous 3s, or at least famous for my age group, are the Hanson brothers. And just because I needed some things to do with 3s, others work better. Trust me on this. But that was a fun group of 3s. What are 3 concerns about group term insurance? Well, and I'm not talking about the first $50,000 that the employer pays for. That's great. It's free. And I'm not talking about the any additional or supplemental coverage that an employer pays for that your client has to take as income and pay taxes on. That's still good. Paying taxes on something is better than paying for something. This is the employee-paid group supplemental life coverage that your clients are paying for through payroll deductions. 3 concerns are the rates guaranteed? Well, no, they're not. They aren't even guaranteed within the particular brackets, and rates can go up. But the rates jump every 5 years, or every quinquennial age. With an individual life or standalone policy they get outside of work, you can guarantee that premium for the duration that they need. How about the death benefit? Is it enough? Well, with the group term, it's generally a formula, 2, 3, 4 times earnings with a cap of $250,000. Just an example. But generally, it's not going to be enough. I haven't seen any supplemental group term that will get somebody, your younger clients, 15 or 20 times earnings. It's usually a much smaller multiple, and even then it may have a pretty small cap on it. With the individual term, they get the amount needed, the amount that they qualify for. Is it convertible or portable? Maybe. It won't be convertible as group term. I haven't seen one that allows a client to keep it as the group term rates. What they may have to do is convert it to some form of permanent insurance, usually a whole life policy. And even then, it's generally not that competitive. A lot of supplemental group term doesn't ask any health questions, or if they do, they're very few. And so when the underwriting isn't done initially for anyone who wants to convert it, generally they're assuming that client's not in all that great a health. With individual policies, yes. Well, first of all, they own it. completely portable. Wherever I go, no matter what job I'm working at, I can take my policy with me. It's mine. And then can I convert it at the end of the term period? Yes. So let's look at the typical group rates, and this is for a male client for $250,000 of the group term and compared to individual level term coverage. If your client's 36, they'd probably look at this and say, well, I can pay $150 a year for the group term, or you're telling me I can lock in a 30-year term for $250. $250 to $290 a year. Unless your client has the ability to foresee 20 or 30 years down the line, then they might opt for the group term. But when your clients get into middle age, this is where the numbers start getting closer and where the individual coverage really starts to win. In this 40 to 44 age bracket, the group term is still $255 compared to a 25-year level term for anywhere from $308 to $365. So we're getting closer. It's less of a difference, and more clients can say, and well, I understand the 308 is locked in, where if I'm 43, I know my group term is going to jump to 430 next year, and it just keeps going up. Now, note, when you get to age 60, that group term is $1,700 a year. For a 60-year-old, they can lock in a 10-year term policy for about $1,000 less. So the sort of the crossover age is right at age 45 for on a today premium what I'm paying. But all the others work out so much better because you've locked in, even though it might be higher initially, over the long term, the premiums paid are much lower. So what's the real cost of this $250,000 group term? Well, a male age 40 signed up for the group term, and he saw that the premium was $255, and that's lower than a 25-year level term policy at $365 a year. And both of those are going to get me to retirement at age 65. So I'll just go with the lower premium. But because of those large jumps in premium every 5 years, over the next 25 years, he'll pay over $21,000 because of the increasing bands on those term policies. The way that the premiums, as he gets older, he just automatically moves from age 44 to 45, and the premium jumped by 30 or 40% for the next 5 years. On the level term, he'll have paid just over $9,000. So he'll have paid about 43% of the group rates over the 25 years. So the real cost of the group term, lower today, but almost another $12,000 in annual premiums he'll pay over the course of his working age. I had somebody ask me, why did layering work best with the larger policies? And I may have touched on that, but the larger the policy is, let me go backwards. With term policies, there is a cost per $1,000 of coverage. The cost per $1,000 of coverage becomes more efficient as policies get larger. So I think I use the example where a $499,000 term policy actually costs more. It will have a higher annual premium than most other companies' $500,000 policies. So even though I'm getting $1,000 more of insurance, I'm paying less per year because I've gotten into that next band. And so it generally works better. Using an example, 3 $100,000 policies will probably cost considerably more than one $300,000 policy. Even if I'm saying that the $100,000 policies are 10, 15, and 20, the $300,000 20-year policy is probably that much more efficient on the cost per dollar of coverage and only having one policy fee. The policy fee is maybe $50 or $60. On a very large policy, that's a small percentage. On a $100,000 policy, it may be a larger percentage. So let's look at 3 real client examples of where how we compare the group term coverage that they could elect to individually owned coverage. Cliff is 57. He's starting a new job, and he can elect $150,000 of group term. This is actually, he started working at a large insurance company. His premium is going to be $200,000 annually at the current age 57, and then his rates are going to increase at age 60. I probably could have dug in more, but when I compared to what he could qualify today for a $150,000 policy, 10-year guaranteed level, and not assuming the super duper preferred rates, but a standard non-smoker rate, $660 annually, really don't need to figure out what the premiums are going to jump to at age 60 because it's too much today. The $2,000 is already high today, so the fact that it's going to jump in 3 years, we know it's going to be a lot more. So over the next 3 years, the new policy saved him $4,000 in premiums. Over the next 10 years, it's going to be $4,000 plus. So again, can save quite a bit of money today, and it just gets better from there. Mary R. in Washington, she was age 52, and she had $160,000 through her employer, and she was paying $636 per year. Sometimes, and this is another way when to the other question, sometimes it's hard to compare because this client really needed about $400,000 of insurance. So how do we compare $160,000 of insurance to $400,000? We're not apples to apples. So what I look at is the cost per dollar of coverage. We would expect that for $400,000 she should pay more, but how do we compare $160,000 to $400,000? We do it on the cost per dollar of coverage. So what she was paying was $3.90 per $1,000 of insurance through her employer. Her individual Transamerica term policy, $400,000 20-year term, at preferred rates, she was paying $730 a year. So it's more, but she's paying about half as much per dollar of insurance or per $1,000 of insurance. So we're able to increase the coverage by 150%, and the premium only went up 15%. That's why I say sometimes we look at the cost per dollar of coverage. The newer, larger policy is just that much more efficient. Another set of clients, Mark S., he has just over $1 million of group supplemental, and he's paying almost $2,300 per year. Isn't sure how long he's going to work at age 51, but doesn't expect it to be longer than 15 years. So same amount of coverage, can lock in a 10-year level premium for $1,400 or lock in a 15-year level term for $1,900 per year. Saves money today, saves money every year that those group rates would increase. Tucker, she has $205,000 through Mark's employer, which is exactly 20% there, and she's paying $455 per year. So we're working both of these together. She really needs $500,000 of 15-year term. So we know that the premium is going to be higher, but how do we compare? She was going to pay $590 per year for the larger policy, almost double. So the current coverage she was paying for through Mark's employer is $2.22 per thousand. The individual coverage, $1.18 per thousand. So it's almost twice as efficient as the group coverage. Now, what are 3 more group life insurance concerns? Well, again, as I touched on, when you saw age 60 or age 65, the group term rates really jump. And then some policies or group plans after age 65 or 70, your client may keep paying the same amount of premium, but instead of raising the bridge, they lower the river. I pay the same amount at age 70 as I do at age 71, but at age 71 they cut my coverage in half. So while my premium didn't actually increase, my coverage dropped in half. Either way, not great. Most group supplemental term plans offer a guaranteed or simplified issue, either no underwriting questions or a handful, sort of like a pass-fail in college. So your clients who are healthier than average will pay more for the group than they need to, because there's others' health impacting their good health. As an insurance company, if I have to, if I'm going to offer coverage to everybody, I know that I have to offer it to you know, the marathon runners and the guy in the iron lung. And so I can't charge a super preferred rate for everybody because I know not everybody is. And then the third thing is the unknowns. What will the future rates be? Well, we see what they're projected to be in 5 years or 10 years, but that's not a guaranteed rate. And then we have the other question of, will coverage even be offered next year? It is subject to the employer providing and funding, supplementing, offsetting those costs for the group term, so that's another question. Individual life insurance, your client owns it, they pay for it, they know what the premiums are, they know how long those premiums are going to be guaranteed. It solves a lot of these concerns. And so we're going to talk about term protecting a business. And so I thought about a good business with, thought of a company. What's a famous company that has a 3 in it? Well, 3M's a pretty big, pretty famous company. But I decided to look at a different company with 3 in it. And so 3's company came to mind, and I had a lot more fun with this one than I ever could have with 3M. So let's say you own an apartment building, and hopefully if you didn't understand my Hansen references, you understand my 3's company references. Beyond that, I'm out. But hopefully one of the two of those will appeal to you. So you own an apartment building, and you want to insure a key person. Well, you want to insure Mr. Roper in the unlikely event that he dies or there's a disability of a valued employee, so that there is funding there to be able to hire Mr. Furley. You're taking that life insurance, the term life insurance, so that I can replace, retain, or rehire somebody to assume his or her duties as the apartment building manager, and may be able to create income to the company. It's creating income to the company, that death benefit, so that I can do all of those things. So who is a key person? And we're going to touch on this really quickly, but it's generally someone who has a high salary. So that means there's a high value on this employee. Decision-making power helps control the direction of the business. And probably your key people will probably have all of these things. Frequent direct client contact. Who's the face of the business, or somebody who, if that person wasn't there, no one would know who to call on. A crucial position. Maybe someone has very specific skills in sales or product management, or really knows how to design, this particular widget. Special talents. Maybe you are the only family advisor who has a completely fluent Mandarin Chinese staff. To be able to find somebody who can do asset allocation and speak Mandarin is probably pretty hard to replace. So that person has some special talents, and maybe you've built a very large business based on the fact that you're the only people who can do that. How much can someone generally, either you as a business or your clients and their business, how much can they insure that key person for? Generally up to 10 times earnings. Just a rule of thumb, a ballpark, a round number, but there does need to be some verification of income. Insurance companies like to know is there coverage on other key employees, and why or why not. And within that, there can be some sort of salary continuation to employees or the beneficiaries of the policies. The design there is that if something were to happen to your key employee, you as a business would be able to hire somebody and have those assets there to do that, but as well as maybe provide the spouse a 1 year of that person's salary. How does it work? The corporation is the owner, payer, and beneficiary of the life insurance policy. I know I get a big collective sigh every time I say this, but premiums are not deductible. But the death benefit is income tax free. So, there's a little sad news, a little good news. That's a key person. So generally, that's not an owner of the company. what happens if we want to talk about a buy-sell, meaning an agreement that is between basically a buyout? And what it requires is there's a legal document of the buy-sell. So the life insurance really is just a funding vehicle, but a buy-sell requires a legal document that has defined trigger points where the owner must sell, the buyer must buy, and there's an agreed upon price or formula. That's what a buy-sell is. The life insurance really is just funding at the death to help fund that agreed upon price or formula. Now there's two ways that you can set up a buy-sell. A cross-purchase. With the cross-purchase, buy insurance where each owner owns a policy on the other owner. So if you have two partners who own $1 million business, they would insure each other for $500,000. Seems pretty simple, doesn't it? What if there's three partners? Well, then each person has to insure each other, and so that requires 6 policies. Maybe if there were 3 people initially, that's not too complicated. Seems complicated to me, but what if we'd had 2 and then add a third? Gets complicated. What if there's 6 partners? They need 30 policies so that each partner owns a proportionate share on each of the other partners. What if there's 6 partners and they add a 7th partner? They need 12 new policies. So cross-purchase gets unwieldy pretty quickly. Now, a stock redemption or entity purchase is much simpler. The corporation buys out the old owner and then retires that owner's shares. With the life insurance, the corporation is the owner and beneficiary. So, however many owners there are, there's only one policy because the corporation, the business, owns the policy on that person. Much simpler. So we moved on to our third life stage, and older. So we're going to look at when we're getting close to retirement, or maybe our term policies are coming to the end of the conversion period. First, I want to talk about pension max. And going with my theme of three coins in the fountain. And famous motion picture. And so I want to, instead of putting coins in the fountain, I want to show your clients how maybe they can put more coins in their pocket. So when a client takes a pension option, they are going to put coins in their pocket. Pension's going to pay them something. Can we put more coins in the pocket through pension max? So generally, when it's retirement time, it's pension election time, well, now it's decision time. So most pension plans will have an option of life only. Should I take the highest amount payable, the highest monthly benefit, highest monthly payout for my lifetime, but then when I die, there's nothing for my spouse, my partner? So the life only option is going to provide the highest monthly payment, but nothing to a survivor. And then pension plans offer some sort of joint survivor option. Generally, we look at the 100% joint survivor that says we're going to pay a lower monthly premium, or a lower monthly benefit, but at the death of one of the pensioner or the spouse, that same amount will continue. So it might be $5,000 as a life only if someone dies. If the pensioner dies, payments stop. Or $4,000 that will be payable as long as one of the two spouses is alive. So that's our decision, basically. And you choose. There are many times when it makes sense to take the joint and survivor option. And I'll touch on those later. But it's a decision that generally we like to have 3 or 4 months ahead of time to look at the numbers, have somebody underwritten to see what makes the most sense. The design of pension max is, can we take the larger life-only amount, that amount that pays to me? I'll put myself in this. I am retiring. I get my pension. Can I take the larger amount that pays on my life only, but then also buy life insurance that will provide my spouse with some death benefit if I die, or when I die? So the question is, how much insurance do I need and how much does it cost? Of course, that's going to dictate this, because how much does it cost? Can I get the right amount of coverage for a premium that makes sense? Well, how much insurance do I need? Our design is to use a single premium immediate annuity to determine the same sort of what lump sum today is needed to create that same income stream. I use it because it includes a mortality assumption that immediate annuities do. It uses a multiple interest rate factor based on the insurance companies, all of their investment portfolio. It's a guaranteed payment and is generally pretty conservative in the earning assumptions. They're not assuming an 8% rate of return. So it's a very, very conservative number of, if an immediate annuity to provide my spouse for the same amount today is $250,000, may be able to if with a different investment option, may be able to create even more income, but that $250,000 is probably the minimum that it would need. And so that single premium immediate annuity determines the death benefit needed by a partner at any point in time. And the amount decreases over time as the partner ages. Remember, this is something that's paying for my life. So if I'm 65, I'm going to die basically at the same time, whether I'm 65, 75, or 85. But when I'm 65, if that age happens to be 86, then I need a much larger amount today to create a 21 years of income as I do at age 85. At age 85, really, I need 1 year of income, and that's about it. So the death benefit decreases over time. And we usually look at this in 5 or 10 year increments, just because that's the way that term policies are priced the most efficiently. So Shadwell is about to retire, and Francis, his spouse, they're looking at their pension. They got all the forms in the mail, and they have a couple months to look at this. And so they called their fee-only advisor and said, what should we do? If Shadwell takes the life-only option, then he'll get just over $52,000 per year. If they take the 100% joint and survivor, they'll get $42,000. So with life only, they're getting about an extra $10,000 a year, but at Shadwell's death, all benefits stop. If they want to make sure that Francis would get something even after Shadwell's death, then they'd receive $42,000 per year as long as either one of them is alive. So that annual cost is $9,500. So there is a cost to that, and it's basically a hidden insurance cost, because there is some money for somebody else at his death. Something happens at his death and it's monetary. There's essentially a life insurance and a mortality cost built into that, and it's about $9,500. So we work backwards. We want to make sure that we can guarantee the same $42,696 for her lifetime should he die. And today, at age 59, that death benefit's about $770,000. In 10 years, it's $570,000. And in 20 years, the SPIA to guarantee $42,000 for her lifetime. Remember, now she's age 79. So do we need the $42,000 for 40 years? No. Much shorter period of time is $370,000. Looks a lot like a term layer, doesn't it? So our strategy is to purchase life insurance on Shadwell, replace the income stream to Francis, and our basic question is it going to cost less than $9,500, because that's what it's costing within the pension. And in this case, yes, as probably no surprise, it's my presentation, so I'm going to find a way that it works. But we can layer a 10-year term, a 20-year term, and a low-load, no-lapse guarantee universal life policy of $370,000. And the total annual premium today would be $7,900 per year. Now remember, he was going to pay $9,500 for a death benefit that looked very similar to this, or it cost them $9,500 for an insurance design like this, where by separating the two things out, he'll actually pay a much lower $7,914 by using the life insurance, netting an extra income initially of $1,662 per year. So I take the life only, the maximum amount, buy life insurance, rather than having the 100% joint survivor option do the life insurance for me. And so we look at this idea here, and it's similar to the term plan. There are built-in income increases, and it's not unlike a cost of living increase, but as the life insurance increases come off, then so their income increases. So initially for the first 10 years, they're going to have the net extra income of $1,662. And in 10 years, that policy drops off. Now they're only paying for 2 policies, and so their net income has gone up by $2,400 per year. And in 20 years, they only have the 1 policy left, so their net extra income is $3,776 per year for the rest of their lives, only having to keep that 1 policy left. And what generally most pension options, and I think maybe I see one a year that has this, is there's a pop-up option. And not this kind of pop-up, not the annoying Internet Explorer pop-ups that pop up and you have pop-up blocker and everything freezes up your computer, but a good pop-up. We've been worried about, we've been talking about the life-only option where Shadwell dies too soon before and have the life insurance on him. If Francis predeceases him, he can simply cancel all the life insurance, and he gets to keep the full life-only benefit of $52,000. So there's a pop-up here. Before they had the $52,000, but less the insurance premiums. If he doesn't need the insurance anymore, he pops back up to the $52,000. If they'd chosen the 100% joint survivor, there is no pop-up. He doesn't get to go back to the $52,000. They locked in the $42,000, and that's what they'll get as long as both or one of them is alive. So again, another way where the pension max works. So when does it work? And I'd say it works 40 to 50% of the time when the retiree is healthy. The retiree has to be a non-smoker. And the retiree has more than 3 months before he or she has to make the payout election. If your client is retiring May 30th and they come to you today to look at a pension max option, it's purely an academic scenario, because I wouldn't recommend that they try it. When they elect a pension, it is an irrevocable decision, and so you would want to make sure that they were able to get life insurance at a preferred or super preferred rate, that the life insurance is already in place before they elected that pension option. So when should they take the joint pension option? Well, the retiree is a smoker or is unhealthy. When most government-sponsored plans, because government-sponsored plans are designed by politicians, not actuaries, then most of the time the government-sponsored plans are generally too rich or too generous. And if the pension payout has any sort of guaranteed annual increases, COLAs, cost of living increases. When it doesn't, we can layer the low-cost term with some permanent. If the pension payout has guaranteed increases all along, then there's very little term because the amount of SPIA needed is generally pretty flat across the client's life expectancy, and so it ends up being quite a bit more because it requires almost all permanent life insurance. And the last thing I want to talk about is the conversion. And not the sort of conversion that we all remember from high school or college, like that little girl was contemplating, but what is a term conversion? A term conversion is a contractual right built into a life insurance policy. It allows your client to exchange a term policy for permanent life insurance. What's key here is that there is no health underwriting required. This is the big aha. If your client was issued at a preferred rate 20 years ago, it converts to the same health class today, preferred non-smoker rate. if they are still in good health, they're still a preferred non-smoker, then a term conversion may have little to no value because they may be able to get a preferred non-smoker rate for a new term policy or permanent coverage if that's what they want. Term conversion has a lot of value when your client is no longer preferred. They're standard, they're table 4, they're uninsurable. Because it converts to that, it still converts at a preferred non-smoker rate. This is a particularly valuable option. And it converts at their attained age. So if I was 21 when I bought the life insurance policy, and now I'm 41 at the end of my 20-year term, it would convert at a preferred non-smoker, male, me being male, male age 41. All the term policies are going to have some definition within the policy, and for the most part, they'll say this term policy is convertible for the term period not to exceed a maximum age of. Most common being 70, a few 75, one I can think of 65. There's no financial underwriting either. So where a client may have qualified for a lot of insurance at some point in time based on future income, later in life maybe they don't have as much income. There's no financial underwriting. The client doesn't have to convert all of the term coverage. They have $1 million term policy. They don't have to convert all $1 million. They could convert $500,000, $250,000, something to leave to their kids. And the last part, if a conversion expires before the end of the term period, you don't have to, it's not an all or nothing or wait till the end or wait till the last day. And as we talk about in my case study coming up, you do have the option to convert portions of the policy and keep the rest as term. So $1 million 20-year term policy could be converted for $500,000 in the 15th year, and then just keep the other $500,000 as 5 more years of term. And again, if it was this kind of conversion, we would probably look at it and just walk away. But your client has a term policy, and so there's some very valuable reasons why they'd look at the conversion option. Again, the first, their health has changed. Their health has declined. That's what makes conversion valuable. But why do your clients ask you about this? Well, it's emotional. Your clients may have had term for 20 years or 30 years, and now that they're financially set, but they're also at a point in time where they actually think about dying. It's not this strange thing out there. I've always had some life insurance, and I sort of thought I've always had some. And so you can guide your clients to the idea, is the conversion valuable? Do they need all of it? Do they need some? One time I had an advisor tell me it's not necessarily that they agreed with that the client needed or wanted permanent life insurance. They didn't. They said they didn't need it. But they were able to talk the client out of converting all $1 million of the term policy that they didn't need to a much smaller amount. I believe it's $200,000 to $250,000. So even then, you can guide the client to keep them from making to getting a lot more coverage than they may need or could afford. And of course, needs change. People are working longer, and so they may not, 20 years may not have been the sort of magic number. And then income replacement, move from income replacement to creating a legacy for children. And again, needs change. Over half of people expect to work past age 65, when we sort of all thought that 65 was the magic retirement age. So usually there's a change in health, age 70, the end of the term period, and that's the go time for the conversion decision. What do your clients need to convert? Excuse me, I'm getting over a cold, and so I was almost over it, but about 10 minutes till 5, I'm not quite there. So what do your clients need to convert? need to convert they need an illustration and a premium check. So Mr. Martin, he's 54, and he has $1.5 million in Transamerica term. And these policies were issued at Preferred Plus in 1999. And he's paying just under $1,500 for those policies. And the conversion and term expiration date is 2019 in June of 2019. So the million-dollar question, actually the $1.5 million question is he healthy? Well, if he is healthy, he can have a new application, a new paramed exam, and he can apply for insurance with basically any insurance company for term or permanent. And if he's still in a preferred, he's still a preferred plus, more than likely, the world's his oyster and can figure out, get basically what he needs. But his advisor said, so that was the first thing we asked. His advisor said, well, Mr. Martin is definitely in later stages of Parkinson's and he's already on disability from work. So his desire is to convert some coverage to permanent right now, but not all of it. And so he has the $500,000 of 20-year term, paying just under $1,500 for a few more years. He decided to keep $700,000 of it as term, paying the $714 per year for a few more years. And he converted $800,000 of it to permanent coverage, and for that piece, he's paying $5,800 per year. So, like the three bears, well, if he'd kept all his term, well, that's a little cold. He'd pay the $1,475 for a number of years, but then to convert all of it in 2009, it was estimated to be $23,000 in annual premiums every year going forward. So that option was a little, little small, a little cold. If he converted all today, well, this one's a little hot. This one's a little too big. The bed's a little too uncomfy. Paying almost $11,000 annually for the $1.5 million. So the middle option, what he decided to do was just right. So keeping basically half of the coverage as term coverage, half of it is permanent coverage. So it's a more manageable $6,600 per year, but still kept the full amount of the coverage for a number of years, and he left open the option to convert more later. Had a question, typical cost for the right to convert term policy versus term policy without the conversion option. Most insurance companies, there is only have the one option, the option that the term is convertible through the end of the term period, not to exceed age 65, 70, 75. I can think of one company that has it for, I think, the first 10 years, and then there's an additional 3% charge with that company to have the conversion last through the end of the term period. But I'd say 80 to 85% of the insurance companies don't have an either or. It's just built into the base contract. So is conversion the best option? Well, for Mr. Martin, it was definitely an option to consider. The additional premiums for this new policy may not be easy to come up with, but what's the value? Because he has Parkinson's, he's not working, he has a disability, but they're also using up other assets for medical bills and other things because he's not earning the income that he was at one point. So you as the advisor can counsel the client on the fact that, yes, there are additional costs for this, but the ability for someone who's maybe uninsurable today to keep a policy at a preferred or even preferred plus rate and to be able to replenish that nest egg, replenish assets at his death, you're in a great position to work with that client on that. And so to answer the question, is conversion the best option? We have a secret weapon. The secret weapon is that you, the client, we can get their current health. And we can arbitrage that against the conversion option that comes without underwriting questions. Again, conversion is very, very valuable if the client's not in good health. If the client's still in great health, then conversion has little to no value. So we covered 6 different topics, all doing my best to relate to threes. Some I thought I was really good, like the Threes Company. Others were a little more of a stretch, but hey, I think I had a couple pretty good ones in there. So that's our presentation about term. For those of you who don't know, who are new to low-load insurance services or working with us, we'll be speaking or exhibiting later this year at the Garrett Retreat. We'll be doing the ACA member webinar, which is no longer the ACA, it's the ACP webinars, the NAPFA Fall Conference in October in Charlotte, and just a number of different things that we reach out to field advisors all across the map. You can follow us on Twitter, and we are the national sponsor of the new XY Planning Network. We offer the top 10 things that make LLIS different. Sorry, somebody wrote in a very funny Three Stooges thing, so I had to giggle. We have our free monthly webinars, and we have 7 more through the course of the year. But what makes LLIS different? We're not your competition. Our only clients are family advisors. We work very hard to save you time and your clients money. We do a lot of pre-underwriting to avoid surprises. We provide tools for you and your clients on our website, and we are a proud sponsor of a number of family advisor networks, NAPFA, Garrett, the NAPFA Genesis group, ACA or ACP, and the newest one is the XY Planning Network. We have product specialists in all of these our different offerings for you and your clients, and we keep you in the loop. When your clients apply for insurance through us, we keep you in the loop with our AIM system, and we're here for the long term, the long run. We're here with you and your clients for years. So we help with our advanced premium email or our APE, help you and your clients remember that premiums are coming due so nothing falls through the cracks. We also have our note or notice of term expiration. So when your clients do come to the end of that term period and the conversion period, to reach out to your clients and to you and to see, do they need insurance longer? How's their health? Is the conversion something we should look into? I had one question on pension max. Don't they have to consider the after-tax amount they have to spend on insurance? For example, the $9,500 less federal and state taxes which are due on the higher pension payment. Yes, but like most questions. In my example, because the pension is 100% taxable, for simplicity, I use the pre-tax numbers. What I would have done is use the after-tax higher number, the after-tax immediate, the after-tax joint and survivor option. Because the death benefit of life insurance is 100% income tax free, then I'd be using a much smaller life insurance amount to compare to the after-tax numbers. So the answer is yes. Could we do that? Sure. But the end result is, if it works one way, if the proportions work out, generally it works whichever way we want to work it. My general design is just to give you an example. And are there any other questions? It's after 5. I'm sure everybody has fun things to do. Maybe go Netflix Three's Company, or maybe go Three Stooges. Maybe probably half of you will be going to Google right now, going to Google Hanson and figure out what exactly that is. But thank you all very much, and I hope, and yes, it is 5 o'clock here in Florida. Many of you still have more of your workday. Yes, thank you for reminding me. But I'm hungry, so I'm ready for dinner. So thank you all very much, and there are some questions here that are popping up, and so I will be in touch with you all here in the next few days. So thank you all very much.